Welcome back to Wealth Mavericks, the podcast where we help doctors unlock the secrets to building generational wealth. And today, we're talking about material participation in your business, what it means, and why it matters. It's really about structuring you and your assets correctly so you can leverage everything that's available in the tax code.
The way people are communicating it is that it's a loophole, that you're taking advantage of the IRS. This is how to get one into the IRS. And that's not true.
Hey, Bob, good to see you.
Good to see you, Erin. Thank you.
Yeah. So today we're going to talk about an important part of tax strategy and one that is, we find, often misunderstood. So we talk a lot about how the tax code is written for business owners. And at Terra Firma, specifically, we say we're helping you build the business of you. Mm-hmm. But it's not enough to just open an LLC or start an entity. It's really about structuring you and your assets correctly so that you can leverage everything that's available in the tax code. And you have to show that you're being active in this business. And that is something called material participation. And I think there's a lot of confusion around it. So today I want to clear that up. So tell us, what is the difference between generating active income versus passive income?
Yeah, no, this is an area that's really a hot topic, and really just kind of give you a history of why this is. Because to your point, there's different types of income, the active income, and there's definitions of what active income is, and passive income, and there's definitions of what passive income is. But on the passive side, there's also passive activity and passive non-activity, which basically is active income, just to make it clear, right? Mm-hmm. And so a lot of these rules have evolved over the years because what would happen is, to your point, people would start a company and then they would just create these companies to create losses. Mm-hmm. And so let's take a step back and talk about the purpose of when you set up an entity. And when we talk about an entity, we're talking about a entity or a structure of a way to do business. And so there's different types. So there are C corporations, which is taxed as their profit and how they perform. Mm-hmm. There's S corporations, which is subchapter S, which is a pass-through, meaning that the owners or the shareholders of that particular business entity, whatever the profit or loss is, passes to the shareholders. Okay, that's what a pass-through means, which is different than passive. Okay, so stay with me. There is partnership, where you have two or more people that are in unison. They're not shareholders like with a corporation, but they're partners, and they have percentage of partnerships, and there's a whole bunch of different rules with regards to that, but also as a pass-through. Okay, then you have a limited liability company, LLC for short, what most people understand. An LLC is a different entity structure, and you can actually choose how you want it to be taxed. So it can be taxed as a sole proprietor, which is the Schedule C of your personal tax return, the 1040. You can be taxed as a partnership. You can be taxed as an S Corp, and you can be taxed as a C Corp, all within the LLC umbrella. So it's really kind of the catch-all, because within the LLC, it has certain provisions within the entity of protections, so to speak, which is becoming more and more popular as an LLC. And then you choose how you want it to be taxed. How it's taxed depends on what tax form gets submitted to the IRS. Okay, so that's kind of the baseline. So when we say entity, that's what we're referring to. Now, when we're talking about active income and passive income, typically passive income is any type of income that is generated where the individual, the owner, the partner, the person is not actively participating in that business. So for example, let's say, well, just real estate is a great example, right? It's the most popular really. And a lot of these rules were established because of how people treated real estate, the tax benefits of real estate. And so the IRS was like, oh, okay, time out. Because people were promoting the key about the IRS is it's a rule book of how to participate in the tax code.
Mm-hmm.
But if there are people out there promoting strategies, promoting tax savings, and enough people do it, the IRS says, timeout, we can't be promoting this. Not because they don't want you to do it, but because they feel like people are doing it incorrectly. They're taking advantage of them, the IRS, as a business partner. And they're right. Because when you set up a business entity, circle back to the very beginning, you need to be in the business to make money. That's the point of a business entity, is to make money. Because of how you're making money, and the tax code may cause deductions from your revenue, expenses, which are deductions from your revenue, that lowers your profit to where it could be a loss based on how the tax code and how you run your business. Okay. So, but if you set up an entity and all you're doing is taking losses and there's no point or desire to make money, then over a period of time, the IRS is going to say, okay, time out. Well, we were giving you some time to make this work because, again, not every business is going to be profitable year one.
Right.
The IRS knows that. In fact, not every business is going to be in business after year one. The IRS knows that. So they give you a time frame, 3 to 5 years, to show that you're able to do so. Okay. Now, some key factors in determining that you can still actually have losses in your business as long as you're showing that you're trying to make money. And that's where the active passive kind of comes into, and that term material participation. So before we dive into that term, let's talk more about how we go through this process. How do we understand of what kind of business we're in and what that looks like? Okay. Mm-hmm. So when we're in business to try to make money, there are certain things that we do on a monthly, annual basis that could cause our profit to be a loss. But our revenue went up, our employee count went up. So if your revenue goes up, your employee count goes up, but your profit goes down, or you have a loss, does that mean you're a business that's not looking to make money? No, you're just the opposite. You are making money. You're growing, which a lot of banks look at your revenue as a form, and how you generate your revenue as a form of how they lend you money. They don't always look at your profit or loss because they know how businesses ran. You may have bought a bunch of equipment. You may end up buying equipment with the loan, and with the tax code, that actually may cause you to have a loss. The bank lending you money actually creates that loss, right? So there's so many different factors. So I think this is all important kind of baseline understanding, and it's probably bringing up a ton of questions, right? Because there are a lot of questions. It's very convoluted. There's a lot. It's a basket. There's a lot of weaving in and out, and different areas of the tax code affect different other areas of the tax code. And but I wanted to make sure we created that baseline of, it's a legal system. It's a legal entity. You got to be in business to make money, and understanding the tax code may create a profit or loss determination, which is the motivation of what the IRS is saying. You need to be in business to try to make money. Okay. So before I jump into anything else, any questions?
Well, so for most of the people we talk to, of course, real estate is their number one. They're either already in real estate or they want to be. And most of them have this misconception that, well, in order to get the big tax breaks, I need to be real estate professional status. I need to participate 750 hours a year, which if you do the math, that's like 15 hours a week on top of your full-time job, which doesn't seem feasible to most people. So then they think, well, I can't get the So what is the difference between the material participation we're talking about and that? Because I think that's something we see a lot.
Yeah. And the real estate professional guidelines adjusted and changed and became very important. And they continue to do so because you have certain strategies like short-term rentals, right? There's a lot of promoters promoting short-term rentals now. I'm of the mindset in the next 5 years that those rules will change again. Because the way people are communicating it is that it's a loophole. that you're taking advantage of the IRS. This is how to get one into the IRS. And that's not true. That's not true. The tax code is written to where you actually have this opportunity, but then people start promoting this, and then the IRS says, say, time out. Okay, now you're trying to take advantage of us because you're just trying to create losses. So on the real estate side, there's a lot of tax code specific about real estate because this is the area that the IRS gives such huge tax benefits for, with depreciation, accelerating depreciation. And rightly so. You and I, as private investors, are better at maintaining real estate than the government is. Because if we don't do it, they do it. And right, they call them the projects, right? And that we know by just saying the projects, it's a failed project, right? It's high crime, blah, 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 all that kind of stuff. So they really rely on you and I as private investors to be able to do this. So we have to abide by this active and passive. And so active is basically proving material participation. And to your point, with a real estate professional, there's that 750 hours, which is different than material participation in normal active income. Okay, so let's talk about those three versions of material participation. The first two are very similar. Okay, the first one is you're working at least 500 hours a year. Okay, just 500, right? Not the 2,080 full-time, 40 hours a week. It's 500 hours a year or more, and you own a business and you have other people or other taxpayers in your business, meaning employees. Okay, you're considered active income. Okay, so that's pretty much every business owner that has employees. The second, very similar, same 500 hours a year or more, but you're an employee with other taxpayers. Okay, so mirror image, one's an owner, one's an employee. That's basically the entire workforce. Okay, you go get your first job, whether it's a fast food joint or you get your first real job is your first corporate job right out of college. There you are. You're an active income. Okay, the third one is you only have to work at least 100 hours, not 500, 100 hours a year or more, and there's no other taxpayer. Okay, so this is your business you've set up. Now, there's a caveat to that, and that goes to the real estate professional caveat. If you do this only to invest in real estate, and you only need to show 100 hours, and you're going to take all these deductions and all these losses and pass that through because you're saying, oh, I'm actively participating, IRS said no. And that's why they changed the real estate professional rules. Okay. But if you're in a business, and let's say it's you and Dave, the two of you guys have started a business and you guys are actively trying to figure out what you want to do to make money. And so you find a local business that you guys really like. The couple's really sweet. You like the idea that they always seem to have clients there. They're always really sweet. And through your guys' conversations, you guys become friends. And over a period of time, you guys go out to dinner and they say, you know what, we really want to expand, but we just don't want to work with a bank. Right. And we don't want to work with a bank. And but we also want to expand. And we've already put so much time and of our own money. So we're looking for investors, and this is just through normal chit chat between the four of you. And you guys come back after dinner because you and Dave talk and realize, well, this may be the opportunity we're looking for. Maybe we can buy into and invest in their business and be part of this and help them expand, but also it helps us because we're diversifying our normal income. So all of a sudden you guys become partners. You invest into it. Okay. Does that mean all of a sudden you're material participating? Not necessarily. Because what if you just put money in there and you don't do anything? You don't meet with them. You don't have conversations, right? You just, here's our money and go do your thing and just give us our distribution or our profit at the end of the year. Well, then that's passive. Right. That's passive. Okay. But let's say you guys meet with them And there's documentation. You guys put together documentation of the meetings and updates. And let's say you and Dave decide to go invest in something else. You do buy a condo and rent it out, right? And it's a condo, so it's not like you bought it for depreciation and cost segregation, because there's not a lot with a condo, but you wanted that cash flow. Well, you're not a real estate professional, and that cash flow, it's passive, but it's passive in the sense that it's still part of your business. So it's active from that perspective because you guys are involved. But there is no accelerating depreciation on that. So you're not just doing it to get a tax savings. Mm-hmm. And then you guys continue this process, and you guys are documenting every step that you guys' involvement in, and you have this bucket of investments and businesses, and you guys are showing that you're working more than 100 hours a year. There's no other taxpayers. It's the two of you. You're meeting with them. Can that be justified as material participation? Yeah, it can. What all CPAs will tell you is no. And they're kind of right, but they're also kind of wrong. And right, I told you it's not clear.
Yeah.
It's based on your motivation. Right? It's based on the understanding of the tax code, but it's also being a good business partner with the IRS. You guys aren't doing this to get one over on the IRS, to stick it to them. You guys are trying to build a business. You're trying to, notice I said a business. I didn't say you're trying to build a bunch of investments. You're trying to build a business that generates revenue. And through this process, you guys are documenting. So in material participation, to show or prove your 100 hours, the IRS, your business partner, says, hey, we're going to give you guys the task to prove to us, your business partner, how much time you're putting in. Okay. Well, you can take a Post-it note and every month jot down your hours that you've done, and you can do that. You can set up a payroll company in your to keep track of your books and clock in and clock out. You're welcome to do all that. You're welcome to do, obviously, your financial statements. But what we prefer is the actual legal documentation of an entity is doing corporate minutes or meeting notes, where you're documenting your guys' involvement. You and Dave meet weekly. You guys meet monthly. You guys meet with the various teams and the various investments that you guys have, and you document those notes. And you keep those notes in your corporate book just to show how you guys are. I mean, you can't remember everything that's being said. And so you want proof, you want document, just in case somebody decides to get, they have money issues, they have family issues, and they start saying something different that wasn't the agreement with you guys. And you're like, oh, no, actually, look here. On this date, we have notes, and this is what we said. Right? And we all signed off on this. That's a legal contract. That's a legal document. Okay? Now, does that mean that you're actually running that business? No, you're running your business. And your business has a bunch of different businesses involved in it to make money. And yes, there's going to be tax benefits in each of those businesses that pass through to you, that you guys get to participate in those. But you're materially participating by proving how you're participating and your desire and your goal to make money. That's the key. Now, will you ever hire employees? I don't know. But the moment you hire employees in this business, now you got to meet the 500-hour criteria, right? Is that a problem? No, if your business is growing to where you need to hire employees that you guys can't handle it, then yeah, you guys are probably putting in more than 100 hours a year.
Sure.
So all of a sudden you match that. Doesn't matter if you still have full-time jobs. The IRS doesn't delineate that. They delineate your participation and how active is it and can you prove it, which is what they're doing with the real estate professional. In fact, there's talk that they're going to change real estate professional to having to be a licensed professional that generates revenue and commission from your activity in real estate.
Wow.
So that could change a whole lot of people's perspectives. Right? So will they change other rules? Of course they will. if people are promoting them the wrong way, right?
Mm-hmm.
But the key is when you start a business, you need to be in business to make money. Why is that? Because the IRS wants taxable revenue. You make money, you end up paying them taxable revenue. That is the partnership relationship. But they also give you, again, the tax code that as you're building and running your business, if certain deductions cause your profit to drop to where you don't have a lot of taxable income or none, that's allowed. You just got to prove it and document it. So this is where we highly recommend don't do your own taxes. Great. TurboTax is simple. Love it. Great. That's wonderful for you. Don't do it. Hire a third-party tax preparer, preferably an enrolled agent, but you can use a CPA because you want a third party to manage and review your books to be able to do a tax return for you. That's part of the checks and balance of being a business. And when you're filing a separate tax return, there's criteria, there's needs and certain compliances you have to abide by to justify the corporation. Okay. These are all steps. Doing just one doesn't make it legitimate. You got to do all these little steps. Okay. It's just like in any type of relationship with a spouse. Just saying I love you doesn't necessarily mean it. You got to show it. How do you show it? Well, it depends on your spouse's love language, right? If that's getting flowers because she loves flowers and it's getting flowers. If it's he likes to come home and change his clothes out of work clothes and gets in and just kind of have that 20 minutes of quiet prayer time, then you give it to him. That's his love language, right? We do little things. It's the same thing with the IRS, right? And that's how relationships work. Okay. But if you're trying to take over, you're trying to take advantage. Yeah. All these rules are exactly what all these CPAs say. No, you can't do that. No, you can't do that. No, you can't do that. And that's because most people come to the question with, how do I create losses? How do I lower my tax? No. It's not. That's a byproduct of all your decisions. You need to make all these other decisions before that to get the reward of a tax savings.
Listening to you explain all this, I think we can see why people are a little fearful of the IRS, fearful of doing these things. And yet they feel so much pain with their high taxes that they're like, I'm going to try it. I'm going to do it. And what you're saying is it's possible. You just don't want to be in one area. And a lot of people are just in real estate. But when you talk about building the business of you, it's all about diversification. And you talk about this dance we play with the IRS. We're not here to just show loss, because we need to show, revenue and gains as well. So like the more diversified you are, the better plan you have. So in Terra Firma membership, how do we help our members show material participation?
So pretty much everything we just talked about, we do. That's exactly what we do. Is we've structured certain aspects of this. We make sure that the main key is everybody understands we're in the business to make money, plain and simple. But I always use this analogy and tell the story of this little small internet company called Amazon. Right, some of our viewers may have heard of them before. Right, Amazon. As a public company, okay, not meaning that you and I can just order stuff online, but the public from an investment perspective, where they go out, they create an initial public offering, and we all can buy shares of Amazon as a public company. That's what I'm referring to as a public company. There's a ton of compliance and scrutiny that you have to go through as an organization, a company, in order to become a public company. Okay. For the first 19, 20 years as a public company, they showed a loss every year. Well, but, they were materially participating. Who was? Bezos. Okay. But more importantly, there wasn't like, oh, I got $100,000 loss. It was millions of dollars in losses. What were the criteria? They were trying to make money. Their revenue was growing. Employee count was growing. The areas of business was growing. So you're allowed to show a loss because they were reinvesting back in the business. It's the same thing with us. This is why I say over 3 to 5 years, it takes time to build a business. So you may start in real estate, but you may build enough equity in your real estate, enough cash flow in your real estate, enough value to where you can get a bank loan from a bank to be able to use that money to invest in a business and be part of that business as a partner.
Mm-hmm.
Right? And your material participation is going to be different. You may be an advisor, not necessarily the boots on the ground. Both are valuable. Both are material participating as long as it's documented. So this is something that we've built out for our members, but documenting it, right? Making sure, hey, we do at least monthly meetings, and you as one of our trusted advisors will meet with the members, and we'll check in, just check-ins. Hey, how are you doing on your goals?
Mm-hmm.
Right? How are you doing with the things that we talked about in your homework? We document every aspect of it, not just, hey, business decisions, but decisions as a business owner.
Yeah.
Right? There's a mindset to business. And what a lot of people don't understand is that should be documented, because that's telling the IRS, our business partner, that we're shifting our mindset from just being an employee and being sick and tired of taxes, and we want to get one over and lower our taxes. This mind shift changes that I'm actually a business owner. I'm a business of me. Yeah, I may be an employee, but my business of me, my expertise is what negotiated and gets that salary. I want to use that salary and diversify the business of me into real estate, into other businesses, to partnerships, into a brokerage account, into blah, 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 all these other assets. Yeah. And I want to document this, and I want to show that my mind shift and change is evolving. All of that is part of building a business. That's all part of the corporate minutes and the meeting notes that shows the IRS. By the way, this only becomes an issue if you're ever audited. Mm-hmm. So all this documentation shows the roadmap of what you are doing and how you're doing it and accomplishing it. So vital.
It's so cool. It just sounds like such a win-win. Like, not only are you saving on taxes, but now, we take that money, we put it into different assets. You're growing your future, but you're growing your mind along the way. And you're getting better in all areas of life. You're being educated on these things. I mean, you and I just had a meeting last night with one of our great members, and his head was exploding. He's like, you have shared more with me in the last 45 minutes than I've ever been taught from any advisor in the last 20 years. In 45 minutes. That's so cool. And like you said, we have the AI note takers in every meeting. We send a follow-up email. There's all this documentation of what we talked about and what we're doing and the progress we're making. And then at the end of the year, you have 100+ pages that, yes, if you ever get audited, which the risk is low, but it's all there for you. So I think people overcomplicate material participation. Mm-hmm. You get to choose, like you said. And you don't have to do this 750 hours. So I think we wanted to ease people's mind about that with this conversation.
Now,
too.
If you're just in real estate, then that's why those guidelines are there, right? But for us, it's all about the asset buddy system. Our philosophy is, let's use more of the tax code. Let's use more of the business partner, the IRS's communication to us than just this one little area.
Yeah.
Right. Let's diversify is what we always hear. Right. And so there's so many. And when you do that in our asset buddy system, you get to actually have the advantageous benefit of different assets in different areas of the tax code that by a byproduct lowers your taxable income. Not because that's what you're trying to do, but you're trying to make money. You're trying to build wealth. You're creating more taxpayers. And as a byproduct, you benefit from it because of what the IRS gives to you. But again, you focus in one area. This is the same thing with business owners. They only have everything's in their business. Well, guess what? They're focused in one area. I'm an employee. Great. You're focused in one area. We're saying diversify. It's really hard. Everything we're saying, it may sound simple based on how we're explaining it. And people may be like, wow, no one's ever told me this. But the action of it is a lot of work. The system we've put in place, is a lot of work. It's a lot of things to put in place because we want to make sure that our partner, the IRS, understands we care about them. Totally the opposite thought process of a lot of people. I've had people snicker at me and say, yeah, no, right. No, right. You take care of them because they're taking care of us. They're taking care of us first by giving this to us. It's our responsibility to reciprocate that. And by doing that, we have a great relationship. And that's the mindset we're talking about. And as it's documented, it's really hard for them to come in and say, you're doing this, you're doing this, you're doing this. Actually, based on the documents and what we're doing, here's what we're actually doing, right? It makes it really hard. The evidence, right? Trying to build out the case before it ever even goes to court. Let's build out the case.
Yeah. That's great. Thank you, Bob. I always learn something from you. I always enjoy this so much. All right. Well, thank you so much, Doc, for listening. We hope you'll join us again. Hit subscribe, tell your friends, and until next time, go be a wealth maverick.